Hello, beautiful people, and welcome to another brand new edition of the ITU Forex class. In this week's edition, we're going to be talking about how to trade with Fibonacci extensions, okay? If you could remember, last week we talked about how to trade with Fibonacci retracement. That's the Fibonacci retracement tools. And I explained to you that the way to use the Fibonacci retracement tool is to time your trade entries, okay? Because by their definition, the Fibonacci retracement tools, it waits for price to begin a trend, and then when it starts a trend, it capitalizes on taking trades in the direction of that trend by waiting for pullbacks to occur in the market. So a typical example of a trade which would be taken based on the Fibonacci retracement tool would be something like this. Let's say the market is in an uptrend, okay? So price is forming higher highs and higher lows. Higher highs, remember market structure? Higher lows. Now the idea is that when an impulse wave forms, and the impulse wave that we're talking about is any wave that moves in the direction of the trend, that advances in the direction of the trend significantly. So an example of this would be, since this is an uptrending market example, an impulse wave will always be the wave that would break above the previous resistance area where price pulled back from. Okay, so and it's naturally, because the market is in an uptrend, the impulse wave is usually going to be bigger than the correction wave. Because let's say this is an impulse wave, okay, and let's say this move is like 100 pips, and then the correction wave, because by virtue of this being a trending market where higher highs and higher lows are formed, if for whatever reason price was to make it all the way down here to break below this starting point or this low, then we're no longer in an uptrend, because an uptrend is supposed to show us higher highs and higher lows. So once a higher low is not able to hold its level here, and it's going to come down for whatever reason to break below the previous low, then we no longer have a higher low. We have a lower low. And so that's not the structure of an uptrending market. But if all is equal, if all things being equal, the trend respects, the market structure respects the typical trend. So for an uptrending market, price is forming higher highs and higher lows. Then this would signal that, okay, this retracement has no business breaking below this low, this origin point. Okay, so if this is truly the case, then we are going to be waiting for when this pullback will end. That's if you're a pullback trader. A breakout trader will place a buy stop pending order and wait for price to break above the previous resistance, which it couldn't break above if the market is trending, before he gets into the market with a trade. While a pullback trader will wait for price to pull back from the highs that it formed, and then when he sees signs that price is no longer able to continue moving down, he anticipates that this will be the end of the pullback and then takes his trade and then rides the trend. Hopefully, he's taking the trade somewhere here because he's banking on the idea that if this is truly an uptrending market, then this is going to respect market structure. And so it's going to eventually break above the previous high that it couldn't break above. And by virtue of doing this like this, when you're taking trades during a trending market using the pullback trading strategy, if you're using the aggressive stop loss determining technique, then usually your risk to reward ratios are going to be much larger than somebody who is using the conservative method. Okay, so the way where Fibonacci retracements come into the picture is they help you to identify where price is likely. Remember, we're not saying with certainty that just because we have an impulse wave and you've drawn the Fibonacci retracement tool and it shows you that, okay, this is the 23.6% Fibonacci retracement level. This is the 38.2 Fibonacci retracement level. So for whatever reason, price is definitely going to respect this level. And, from that level, it's just going to continue moving in the direction of the trend. No, we will have the levels on the chart, and then we'll look at how price reacts to those levels. If, for whatever reason, we draw the Fibonacci retracement tool using this impulse wave, and then when price starts to pull back, it just breaks below this 23.2 Fibonacci 23.26% Fibonacci retracement level, like it wasn't even there. So we have a very big bearish engulfing candlestick that just broke below this level like it wasn't even there. Then we're obviously not going to take a buy trade at that level because price is not respecting that level. It's not reacting to that level as if it wants to reverse and continue moving in the direction of the trend. So what I mean is the way we want to use the Fibonacci retracement tool, this is what we talked about last week, because I want you to have a clear picture of how these two, because this Fibonacci retracement and extension, they work together to help you build a foolproof trading system. Fibonacci retracement tools, in a nutshell, they help you to identify your trade entries during trending markets by identifying price levels where price is likely to stop its pullback and continue moving in the direction of the trend. While the Fibonacci extension tool, which is what we're going to be talking about in today's class, is used to help you identify what could be your potential profit target level. So if you use the Fibonacci retracement tool to identify your trade entries, you're then going to, if you choose, because for your trade exits, you can choose whatever you want to. You can choose to use a fixed risk to reward ratio. So whatever trade you take, for example, if you're risking 1% of your trading account capital, or if you're risking 1 pip, you'll be looking to make something like 3 pips, for example. This is if you are trading with a 1:3 risk to reward ratio. Okay? So you can choose to use a fixed risk to reward ratio for your exits like this. So regardless of the trade you take, anytime price just hits 3R, you're just going to take your profit and call it a day. Or you can choose to use a tool like the Fibonacci extension tool here, which is kind of dynamic, because when you take a trade, it's going to factor in where the impulse wave started, where the impulse wave stopped, and then where your retracement ended. And then it's going to help you, it's going to draw Fibonacci expansion levels in the future, multiple Fibonacci expansion levels, and then you pick and choose based on your trading system or your risk management or your backtest which one you see that it works best with your trading strategy, and then you choose to use whichever one of them you want to use for your profit taking. Okay, so the reason why I revisited last week's class is because last week's class, understanding last week's class is crucial to building upon what we're going to be learning today, because we're going to be, just like I told you, would be using the Fibonacci retracement tool to identify trade entries during a trending market when price pulls back. And then would now be using the Fibonacci expansion tool or the extension tool. Some platforms like the MetaTrader like to call it the expansion tools, while some platforms call it the extension tools. Okay, it's all the same thing. It just helps you to identify where the beginning of an impulse wave is, where that impulse wave stopped, and then where the retracement stopped. And then it will help project into the future where you should aim to take your profits at. That's all it does. It just helps you to identify trade exits. Okay? So with that out of the way, let's do a quick little example before we move on to the charts to look at live examples of how to use the Fibonacci expansion or extension tool. Okay? So remember I told you that the way the Fibonacci retracement tool works is the market needs to be in a trend before you can use the Fibonacci retracement tool. Because if the market is not trending, then obviously if the market is stuck in the trading range or if it's consolidating, it's not going to be making higher highs and higher lows for an uptrending market, for example, or lower lows and lower highs for a downtrending market. And because that is not going to be forming, then you have no business taking pullback trades when the market is not even trending. Because the idea is that when there's a trend in the market and you're waiting to take trades when a retracement ends or when there's a pullback, the idea is that you are capitalizing on the logic that when the market is in an uptrend, it usually forms, let's say this is our low and this is our high. It usually forms a higher low because this low is higher than this origin low, this beginning low. While this high that it formed is called a higher high because it's higher than this previous high. Okay, and this is anticipated to be a higher low because if for whatever reason price does not stop here and it comes all the way down here to break below this higher low, then we are no longer in an uptrend. An uptrend for us as market structure traders is characterized by price showing higher highs, higher lows, higher highs and higher lows, higher highs and higher lows. So if for whatever reason price is breaking below the higher lows, then we are no longer in an uptrend. Or if it's breaking above the lower highs during a downtrending market, we are no longer in a downtrend Because if the trend is healthy, if the trend is strong, it has no business whatsoever for price to come all the way down to break below those higher lows, or vice versa. Okay? So, assuming we're using this technique, then when there's two ways that I told you that traders use to enter into a trade when the market is trending. A breakout trader is going to say, okay, since the market is trending and when it came to this price level, it couldn't break above this level, then I'm going to place a buy stop pending order, maybe 1 or 2 pips above this level. That price was finding it difficult to break above, and then if for whatever reason price comes up all the way up here and breaks above this level, then we are capitalizing on the assumption that if the market is trending, it's going to keep forming higher highs and higher lows as long as that trend remains intact. So the thinking of this type of trader, a breakout trend trader, is that when price breaks above this resistance, which it couldn't break above previously, then it's likely going to continue moving in the direction of the trend to form a brand new high, a brand new higher high. Okay? And if that is truly the case, then the breakout trend trader is going to place a buy stop pending order here, which is going to get price to trigger him into the market with a long trade when this trend continues. And then he can use two aspects to identify his stop loss. If he's using the aggressive stop loss technique, then he's just going to place his stop loss just below the level where price respected, okay, and failed to break below, okay. But there are pros and cons to both of these methods. If you're using a tight stop loss like this, then you're likely going to get stopped out more often than not. Price could just hit your stop loss and then move in the direction that you anticipated that it would do. There's no way to avoid this, okay? You can't have your cake and eat it. So in trading, you just make do with what you are more comfortable with. If you are more comfortable with getting a very low win rate, but then that low win rate is compensated for by having a high risk to reward ratio, meaning, for example, you place your trade, you place your tight stop loss, and then anytime you take a trade, you are risking 1% of your trading account capital, or you're risking 1 pip, for example, and aiming to make 5% or 5 pips. So by virtue of this, because your risk to reward ratio is high, even if you have a very low win rate, like maybe let's say 30%, because you're trading with a 1:5 risk to reward ratio, that will automatically make you very, very profitable. Because just think about it. Let's say we take 100 trades. Okay, let's say we take 100 trades. Out of those trades, you have a 30% win rate. 70 of them were losses, okay, L, and then the 30 of them were wins. Now, in this case, the 70 trades that were losses, you only lost 1% of your account capital on them. So your gross loss is minus 70%. While the profitable trades that you had, each one of them gave you a profit of 5%. So when you multiply 30 by 5, you're likely going to get 150% plus 150% gross profit. So when you subtract your gross loss, which is minus 70%, from your gross profit, which is plus 150%, you'd still end up with a profit, ROI, of 80%, even though your win rate was only 30%. You see? So somebody with this mindset will be like, okay, you know what? I don't care about having a low win rate. I don't care about having, a very, very long losing streak, maybe like 5 or 10 losing trades in a row. Because if you have a very low win rate like this, and maybe 70 out of 100 trades that you take are likely going to hit their stop losses, then it's not uncommon for you to have like 10 losing trades in a row. But let's say this person has already worked out the math, he's already done the back test, and he's comfortable with having a very low win rate because that low win rate is compensated for with bigger profits because of his high risk to reward ratio, then so be it. You go for it. Okay? So you're going to use this technique and have your very aggressive tight stop loss. But then there's some other trader that is not comfortable with having a lot of losses and a very small win rate. And so for that type of trader, he prefers the conservative approach. So instead of placing his stop loss very close to where he entered the trade, which would naturally mean that he will get stopped out more often, he is comfortable with placing his stop loss very far from where he entered the trade, in a place that if price was to hit his stop loss, then automatically his trade idea is invalidated. Because just think about it like this. Let's say you take a trade somewhere here when price made a pullback, and then you place your stop loss below the low where that move started. So let's say this is our low and this is our high, and you placed a trade somewhere around here when the pullback, there were signs that the pullback was going to end here. Maybe you saw a bullish engulfing candlestick, maybe you saw a doji for indecision, or a long wicked candlestick, or anything like that, that's showing you that the bears are finding it difficult to keep pushing prices lower. And so that is an indication that price is wanting to start continuing to move up and break above the previous resistance that it failed to break above. So if, let's say, you take a trade here and you place your stop loss all the way down here below this low, which is our origin point here, then if for whatever reason after you entered the trade, price came all the way down here, does this mean that we are still in an uptrend? Of course not, because for a healthy uptrending market, price needs to be forming higher highs and higher lows. And if for whatever reason price comes all the way down here, instead of forming a higher low HL, but it comes all the way down here to break below this low, then this is no longer a higher low. It's actually a lower low, because it will be a low that is actually lower than this previous low. So the trend is absolutely not there. It's gone. So for this particular trader, he's using this technique because before price, if the market is truly in a trend, even after he gets into a trade here, price can move down, maybe, take liquidity, stop some traders out, then, consolidate or whatever. But eventually, it might just continue to move in the direction of the trend without invalidating the trend by breaking below this low. So this trader is naturally going to have a modest win rate, a win rate which is higher than the trader who is an aggressive trader who has a very tight stop loss. But because his stop loss is very far, this would affect his risk to reward ratio, because let's say he's risking 100 pips on the trade. That's the conservative trader. For him, if he was to take a trade with the same risk to reward ratio as somebody who is using the aggressive method, then his profit target will have to be 500 pips away. Now, for price, especially for currency pairs that are not very volatile, currency pairs like the Euro USD, for price to make a 500 pip move in your favor is going to be very, very difficult. Okay? And so automatically you have to think about this when you are creating your trading strategy or your trading plan. So think about the pros and cons. If you're okay with having a low win rate but a high risk to reward ratio and more profits, you don't mind having losing streaks that are very long, it's not going to affect your psychology, then go for it. But if you know that just 2 or 3 losing trades in a row can start to destabilize you, then you should use the conservative method. And then, because your win rate is going to be slightly higher than the person who is using the aggressive method, but your profits also are going to suffer. So your profits is going to be slightly lower than that person's. Okay? So let's assume that you've already understood all of this. How does Fibonacci expansion fit into all of this? And that's exactly what we're going to look at now. So moving on. You see the chart you're seeing on my screen right now is a chart of the GBP USD currency pair, which is the 4-hour chart. If you take a close look at what we had here in the past, you notice that price was in an uptrend. And why do I say that price was in an uptrend? It's simply because you can see that price started moving from here, which is our low, origin point low, because all of the lows that we had prior to this, there wasn't a low that was as low as this. Okay, so this was our low, origin point. So you can see that price moved from this low all the way to this high. So let's say this is our low, label this as our high. Then you can see that price pulled back from this high. Okay? And then this uptrend that we are anticipating in the market, it is intact, because for whatever reason, even though price pulled back from the highs that it made here, it never broke below this low. Okay? So this is automatically going to be labeled our higher low, because price couldn't break below this low. Now, for a pullback trader, once he sees this bullish engulfing candlestick, even though you can argue that the body of this bullish engulfing candlestick hasn't fully engulfed this previous bearish candlestick, but it has engulfed more than 50% of the candlestick. So depending on how you want to take your trade setups, this could be a trade entry for you. So you could place a buy stop pending order just above the highs of this candle, because if for whatever reason price is going to be able to break above this candle, then that would mean that we've engulfed this bearish engulfing candlestick completely. And since we are in an uptrending market, the assumption is that price is likely going to break above this high and form a brand new high. So if we take our this as our impulse wave, okay, because it's the wave that is advancing in the direction of the trend, then this would be our retracement. We'll take a trade here, place our stop loss just below it if you are using the aggressive technique, and then if you are using, a fixed risk to reward ratio, you can use a simple 1:2 or 1:3 or whatever you want to use as your exit. But if you were to use the Fibonacci expansion tool, this is where you find it in MetaTrader. So you click on insert, click on objects, and then you can see we have the Fibonacci tool here, the category of Fibonacci tools. Now you select the expansion tool. And so the way you would use it here is you'd say, okay, this is our impulse wave. And so the move started from here to here. We started from this level here, and then we moved from this level to this level here, and then this was where our pullback ended, here. Now you can see that since our pullback ended here, the Fibonacci expansion tool is telling us that if we want to use the 61.8 Fibonacci expansion level as our profit target level, then our trade profit target will be somewhere here. If on the other hand we want to use the 100% Fibonacci expansion level as our profit target, then our profit target will be somewhere here. But if we wanted to use the 161.8 Fibonacci expansion level as our profit target level, then this would be where our profit target will be. Now, with this in mind, I've configured my Fibonacci retracement tool to in MetaTrader to help me kind of see where my profits are at and all of that, okay? So let's assume that you're using this as a trade entry. Remember, I told you that we'll place a buy stop pending order at the height of this, at the high price of this bearish engulfing candlestick. Because if for whatever reason price is to break above, then this candle is totally engulfed. If you are using the aggressive method of stop loss placement, then your stop loss is going to be placed just below this level. Okay? So if your stop loss is placed below this level here, and you are using the Fibonacci 61.8 Fibonacci expansion level as your profit target, you can see that this is barely a 1:1 risk to reward ratio. In fact, it's not even a 1:1 risk to reward ratio trade. It's a 1 to 0 point something risk to reward ratio trade. Now remember, because you're using, if you were to use the aggressive stop loss placement technique, you are not going to be profitable if you're using just a 1:0 point something risk to reward ratio trade, because you're going to be stopped out more often than not. So your profit target, by virtue of you using that very, very tight stop loss, should be very, very high. So let's say that if you were to use the Fibonacci expansion level of the 100, okay, that's 100% Fibonacci expansion level, then based on where this stop loss is, hypothetically, your profit target will be 2 times what you're risking on the trade, which is not bad. But if you're using a tight stop loss, I would prefer it for you to use at least have a 1:3, at least a 1:3 risk to reward ratio for your profit targets, because that will make it more worthwhile. Because remember, your win rate is going to be very low if you are using very tight stop losses. So if your win rate is very low, the only way you can balance that is for you to have very, very big profit trades. And so if you're using the Fibonacci 161.8 Fibonacci expansion level as your profit target, then you can see that for this particular trade setup, your profit target will be more than 3R. So if you're risking $1, your profit target will be maybe something like $3.4 that you're going to make on this trade, which is not bad. Because if you continue trading like this, after taking like 100 trades, remember, we don't just do this and say that, okay, since I have a 50% win rate or a 30% win rate, whenever I take 10 trades, they are going to be exactly 3 winning trades and 7 losing trades. No, there's variance in trading, okay? So that's why for you to have the edge, the edge of your trading strategy to play out in your favor, you need the law of large numbers to work in your favor. You need to take a lot of trades. So let's say you took 100 trades, and let's say, give or take, you won 30 trades and you lost 70 trades. If you're using a 1:3 or maybe 1 to 3.5 risk to reward ratio, then those 70 trades that you lost would only cost you a gross loss of minus 70%. While those 30 trades that you won, each of them would bring you at least a profit of like 3 times what you're risking. So 3 times 30 trades is going to give you plus 90% profit. When you subtract your gross loss of minus 70% from your gross profit of plus 90%, you still end up with a plus 20% ROI, even though you have only a 30% win rate. Okay, so remember, this is the example of you using the aggressive stop loss placement technique. So your stop loss is just below where you are anticipating the pullback to end. But what if you were a conservative trader who is not too comfortable with taking a lot of losses and having a high risk to reward ratio which would compensate for those losses with bigger profits? What if you are a trader who prefers to have a relatively high win rate, even if your profits would be kind of smaller as compared to somebody who is using the aggressive method? Well, then your stop loss will be placed somewhere below here. And why is it placed below here? Because remember, this is our low. This move started here. This is our high where this move ended, and so this is our impulse wave. And so when price made this pullback and it formed this bullish engulfing candlestick, the idea is that if price is truly in an uptrend, then it has no reason whatsoever to come and break below this low. And if for whatever reason after we entered a trade here, price was to come all the way down here to break below this level, then that's no longer an uptrend, because the market structure of an uptrending market is the formation of higher highs and higher lows. So if price was to come all the way down here, this is no longer a higher low. It's actually a lower low. So that's why this stop loss being placed here makes sense for the conservative trader. But then remember, I told you that because the stop loss of the conservative trader is a bit further than the stop loss of the aggressive trader, which is more tighter, his risk to reward ratio is going to be affected. And so for that particular trader, if he's using a risk to reward ratio of maybe 1:5, his profit target is going to be very, very, very far. And because his profit target is going to be very, very far, his trades are going to take almost forever to hit their profit target. You understand? So there are pros and cons to this. So if you're using the conservative method, the advice I would give you is to use a risk to reward ratio which is at least something like 1:2, which is not too bad. In this case, if you were using the conservative stop loss placement method and your stop loss was somewhere here and you entered into the trade somewhere here, then if you are using the 61.8 Fibonacci expansion level as your profit target taking level, then again your risk to reward ratio would be 1 to 0 point something. So you're not even making if you're risking $1, you're not even aiming to make $1. You're aiming to make 0 point something, and this will not work if your strategy has a very low win rate. For this to work, your strategy needs to have your win rate in, close to 90% before you can make smaller profits and lose larger when you take a loss and still be able to make a profit at the end of the day. So if you want this to work out, you need your profits to at least be 2 times what you're risking. So what if we were using the Fibonacci expansion level, the 100 Fibonacci expansion level for our profit target? You can see that your profit target will not be 1:2 still. It's just going to be slightly above 1:1. But what if you're using the Fibonacci expansion to 161.8 as your profit target level? You can see that your risk to reward ratio will be more than 1:2. In fact, it's going to be maybe 1:2.5 or something, 2.3 or something, which is not bad. So using this technique, it would be more in your favor, more in your favor to actually place your stop loss, your profit target using the 161.8 Fibonacci expansion tool. So I hope this all makes sense to you. For you to use the Fibonacci retracement tool, you need to identify an impulse wave. And then after identifying that impulse wave, you need to wait for price to show you that a pullback has ended or is likely to end at a certain Fibonacci retracement level. And then when you see how price reacts to that level, when you see the formation of something like a bullish engulfing candlestick or a long-tailed candlestick or all of that showing us price rejection, you can place your trade and then choose one of the 2 methods of stop loss placement. Are you going to be using a tight stop loss and going for high risk to reward ratio? Pick that method if that works for you, if you are okay with having a low win rate. Or are you going to be using a conservative approach for your stop loss placement, which simply means that your stop losses are going to be wider, but your profit target, your risk to reward ratio is going to be smaller. But this would be good for traders who because it's going to improve your win rate slightly. This will be good for traders who do not like taking lots of losing trades in a row. Remember, trading is not just about risk management or a trading strategy that works. It's also about psychology. And that's why you need to factor all of this when you create your trading plan, to have a holistic approach to trading, which is going to help you become profitable overall. Okay? And this is exactly how to use the Fibonacci expansion tools together in tandem with the Fibonacci retracement tool to identify trade entries and exits. Okay? So I really hope this hammers the point home, because if you understand this, you can manipulate the market anyhow you want to. You can just, and you can trade any instrument you want, because once you identify that an instrument is trending, whether it's Forex, whether it's stocks, whether it's whatever, you know that the market structure for an uptrending market is the formation of higher highs and higher lows and higher highs and higher lows. Or the market structure of a downtrending market is the formation of lower lows and lower highs, lower lows and lower highs. And at the end of the day, when you understand this, you just look for the impulse wave, wait for the retracement, place the trade, and choose your stop loss placement technique, choose your exit placement, profit target placement technique, and just roll with it. Okay, so I really hope this boils the point. This explains the point for you clearly, so that you can see exactly how all of these things come together to work in tandem. Okay, before we wrap up the class, I would like to use this opportunity again to let you guys know about our ITU bots. Okay, which are trading robots, which are automated strategies that are designed to trade on your behalf while you are out there doing what you want to do without needing to sit in front of the charts. They will trade, manage the risk, identify low risk trade, set up trading opportunities for you, and then place the trades and help you to make money even while you sleep. Okay, manage your does this mean that the bots do not take losses? Of course they do, but notice what I said here. They help you to manage your risk properly, as long as you don't get greedy. So if you're interested in them, please reach out to us on the socials or drop a comment in the comment box, and then we'll be more than happy to assist you set everything up with our step-by-step tutorials and everything else. Okay, so I look forward to seeing you guys in next week's edition of the ITU Forex class, where, as usual, we'll be giving you tips, tricks, and techniques which would help you to become a more profitable Forex trader. Okay, so I look forward to seeing you guys in next week's edition, and God bless you. Have a wonderful rest of your day and your week. Cheers. Go out there and crush the market. Okay.